Every day the economy gets weaker and weaker. There's no chance in stopping the decline without drastic change. We will never see that change because the globalist elite have control over every sector, every institution, and every function of all countries globally. So what is the solution? Sadly, there's no way to turn this ship around, but you can make changes in your own paradigm which will protect you and your family. First, we must acknowledge the truth, and that's why you came here for the truth, so let me unveil that for you. I'm going to cover so many different issues today. I'm going to go all over the board, and I want to touch on the economy itself. We're not going to look at particular stocks. I don't want to focus on any technical indicator like moving averages, but I want to cover so many different things, and I wanted to start with this article out of the Wall Street Journal. Revenue growth at U.S. companies is slowing, stirring concern that a corporate profit boom that had driven the Dow Jones and other major stock indexes to dozens of records in 2018 is in jeopardy. And what they're talking about here is BlackRock, International Business Machines, IBM, this month reported disappointing quarterly sales, citing such factors as cautious customers, rising costs, and a stronger dollar. So far this quarter, 35% of 85 reporting S&P 500 companies have missed the analysts' sales forecast. And if that continues, we're going to have a big problem this time around. Now, all companies haven't reported yet. And of course, this is one that we've expected to actually do better than all of the analysts' forecasts. So it's going to be hit and miss here. And I think it could go either way at this time. There's a lot of turmoil and tension today, and a lot of that has to do with interest rates. I do believe that this is the most important factor that we are witnessing as the events are taking place. This happens to be the 3-month Treasury bill, and you're looking at this as an indicator of what's happening with interest. You could see that there were years and years of zero interest rates. Look how long this unprecedented 0% interest rate from the end of 2008 to the end of 2015. This entire time, interest rates are 0%. And that's unheard of. And then there have been these moderate increases, as we've seen over the years, taking its time to increase to a level of just over 2%. And this is already starting to constrain the economy. Can you believe it? We were at zero for this long, and yet going the slowest possible rate they have ever done so. And yet 2% is enough to constrain. They're already too tight. We've heard many analysts, many individuals out there suggesting 2%. Now, this is just the bonds, Vanguard Total Bond Market ETF. This is huge because it's a $200 billion market cap. And we can see that this has done so poorly all of this year. This is a 1-year chart. If I go year to date, it looks even worse. But these are all part of the same compost heap. We are seeing all of these different indicators piling up that look terrible. Whether it's something like the total bond fund here, or whether it is looking at emerging markets, or whether we're looking at the effect of rising interest. Maybe we're, suggesting that in the United States, home builders, they're doing terribly. Banks, global systemically important banks, and so many other factors are all looking very, very bad at this time. This is a very messy chart, but essentially what we have here is Goldman Sachs suggesting that in the next quarter and into the first quarter of 2019, we're going to have major effects on growth. It's going to move into the negative territory, and we are going to see why that is the case. Very clear that with interest rates rising, quantitative tightening, it's going to have a major impact. There's no doubt. Right here is something that I have consistently been reporting on and will continue to do so, because no matter what boost the consumer gets, it seems like it's always turning around and hitting them again. They're never able to climb out of it, maybe temporarily, and then they get hit down again. Employed full-time, median, usual weekly real earnings, wage and salary workers, and you're seeing this right here. Adjusted for official inflation, full-time wages rose $6 a week in the past decade, $300 a year. Adjusted for real-world inflation, workers lost ground. And that's what needs to be understood. That you can suggest to everybody that, okay, wages are rising a little bit, that's great, but you're not factoring in real inflation. And when you do, you find it's a slow and steady decline. And that's wages for you. Wages do not keep up. Imagine somebody coming out of university, they've spent all that money, they need to get a job, probably not going to be able to get the job that they want. They come out, they're heavily in debt, and now the job that they take doesn't pay enough, doesn't pay what they expected. And that's a terrible cycle that we're in today. This is the CPI. I mean, if we look at the core CPI, my goodness, that's terrible. The Federal Reserve's favorite level of inflation, favorite so-called index. Shouldn't even be called an index. It's so bad. It's just a lie. That's all it is. But this is the CPI. And it's from the BLS, by the way. And they put it into this pie chart here, and I thought it was interesting to see that housing makes up almost 42% of it. And in second place here, or third place, we're seeing food and beverage, transportation. Okay, so our vehicles, insurance on those vehicles, gasoline, the taxes that we pay, all sorts of different, depends on where you live, but you got to get your license plates. They need to be renewed often. Your driver's license needs to be renewed. These are all fees that you have to pay. You can't get away with it. There's so much taxation and so on. You add that to the food on top of this, the amount of expenses that we incur on a regular basis is unbelievable, and every year it just gets more expensive. When you look at rent or mortgages in housing, when you look at what we pay for our energy, if they've included that in here, I assume, energy, to heat the home, powering the home, depends if you're using gas or electricity or whatever, it doesn't matter, it's probably all gone up. And then so on. You know what I'm getting with this, right? The costs keep rising, and in most cases, the quality is decreasing. This year shows us real economy prices versus asset prices, and that leads me into my next couple points here. These are, I really want to put quotes around real, because it's not real, but we're looking at the GDP numbers, US GDP, EU, US wages, CPI, and so on. Those are the quote-unquote real. And their inflation, total return performance in local currency since January 2009, is dismal in comparison to asset prices. Whether you're looking at the S&P 500, whether we're looking at the MSCI World, which hasn't done very well recently, the MSCI Emerging Markets, and so on. Since 2009, clearly, you're better off holding on to particular assets. That's very clear. And also, we know that there's been a divergence in between people's wages and assets that hasn't corresponded. And there are periods of time in history where it does this. And I'll show you more about that in a second. Households and nonprofit organizations' net worth level. Taking a look at this, it's basically comparing these two. I'll read this in a second. But this line here and the GDP. So while the GDP definitely has increased since from the year 2000 up until 2017, it has truly increased quite a bit. But the GDP is definitely disconnected from all of the, if you want to call it net worth. It doesn't make any sense. There's a complete dislocation in between these two, and there's a chasm that has formed, and as time goes on, it only gets worse. And I don't know if the next chart shows me that. Let me just flip ahead. Yes, right here. Asset prices versus the GDP. So the red line is the GDP, and net worth of US households is the blue line. And you'll see that there are times when this begins to get very close together again. Whether it is the increase in the GDP or we have a massive decline in the net worth of US households. Perhaps that's with housing, perhaps that's with the stock market and so on. We can see it decline. So in the event that happens, we can either expect the GDP to turn up at a rapid rate, or we will see assets declining, or both. So usually they drop down together, but we're going to have to see. We're only going to know in the pages of history. We're not going to be able to predict when this type of event will occur. And last but not least, wealth inequality. It's no surprise to me that we see this all the time. The bottom 80%, financialization and debt expansion take off. 1984, bottom 80%, seen nothing. All right? It's just, this is the way it is. Ultimately, you have individuals in the bottom 80%, they work a 9-to-5 job, they are paying their bills if they can, they have maybe a car, maybe they rent a home, maybe they buy, but they don't have that much money to invest. Maybe they have a little bit here and there, but it's not a significant amount. It just doesn't make a difference. I mean, when you add up those 7 shares of Amazon, it doesn't make much of an impact. But when we look at this, of the top 1%, they're investing in every asset. They've got everything. I mean, depending on who you look at. They've got stocks, they've got bonds, they've got land, they've got real estate, multifamily, commercial, retail, everything. They own some of everything. And the way that we see this here happening has been only getting worse as time goes on. They keep making more and more and more money, and the lower interest rates go, the worse this is. But now interest rates seem to be increasing. So I'm wondering, is there the potential that the average person is going to get a little boost? It's possible. It's certainly possible. But in terms of control, in terms of power, that top 1%, and more specifically the top 0.0, at least 0.01%, but perhaps a few more zeros in there, they're the ones who control it all. So I'll end the video there. If you found it informative, please give me a thumbs up. And give me a thumbs up, you're supporting this channel. You're supporting nearly 150,000 subscribers here on the channel. So just hit that thumbs up, hit that subscribe button. We're literally, days away now from hitting 150,000 subscribers all over the world. This is incredible. The amount of knowledge that the subscribers share on here. If you're new to the channel, you're going to see, check out the comment section on all these videos. I do videos on every country around the world. I'm always collecting, always grabbing data about all different countries, not just the United States. So stay tuned no matter where you're from. Hit that subscribe button, hit that like button, and If you want to check out my books, there's a link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.